Governments can create wealth without producing anything, a power almost no one truly understands. And to see how they do it, we need to uncover the mechanism hidden inside money itself. Most people imagine money as something physical: cash, bills, metal coins, something that must be printed, mined, or produced in a factory. But the modern financial world works very differently. Today, money is not primarily a physical object. It's a system of trust, expectations, and agreements woven into the global economy. To understand how governments create wealth out of thin air, we need to break apart the illusion that money must always come from something tangible. Because the truth is far stranger, far more flexible, and far more powerful than most people ever realize. For more than a century, economies relied on metals like gold and silver to define value. Governments could not simply create more money whenever they wanted. They needed the physical metal to back every coin and every note. It was simple, predictable, and comforting. If a nation didn't have gold, it couldn't print more money. If it wanted to grow, it had to mine more metal or trade for it. But as economies grew more complex, the world discovered the limits of this system. Countries could not grow fast enough, businesses could not expand quickly enough, and governments could not respond to crises in real time. The economy was chained to the earth, to whatever gold could be dug out of the ground. So over time, countries abandoned this limitation. They stepped away from metal-backed money and toward a system based on credit, trust, and the power of governments to create money themselves. Not magically, not recklessly, but through structured mechanisms that allow money to expand and shrink depending on what society needs. This transition didn't happen overnight. It evolved through wars, depressions, recoveries, and political decisions that shaped the world we live in today. And now, every major economy on Earth uses some version of this new system, one where money is created not by digging, but by decision. But to understand the process, we have to start with the simplest version of money creation, the relationship between governments, commercial banks, and central banks. Most people believe that governments print money directly, but this is only a tiny part of the story. In reality, most money is created when banks issue loans. When a bank approves a mortgage, a business loan, or a credit line, it creates new money, money that did not exist the day before. The borrower spends it, the seller receives it, and the economy grows from the new activity. This is the first layer of the wealth machine, credit creation. Banks don't lend out old money. They generate new money through accounting entries. It's legal, controlled, and monitored by central authorities. And it's the backbone of modern capitalism. But what about governments? How do they enter this picture? The answer lies in government bonds. When a government needs to fund public services, build infrastructure, or respond to emergencies, it issues bonds. Investors buy these bonds: pension funds, foreign governments, banks, and individuals. And the government receives money to spend. Now here's where it becomes interesting. Central banks can also buy these bonds. When they do, they create new money electronically to pay for them. No printing presses, no gold, no physical constraint, just numbers added inside a secure system. This newly created money enters the economy through government spending. Roads get built, salaries get paid, projects begin, and economic activity expands. Some people call this process printing money, but it's more accurate to call it monetary expansion. This mechanism is not unlimited. Governments can't turn it on forever, and central banks can't buy bonds without consequences. If too much money enters the economy too quickly, inflation rises. If not enough money circulates, the economy slows, unemployment increases, and businesses collapse. So the wealth machine is not magical. It's a balancing act, a constant adjustment between growth and stability. And the reason governments appear to create wealth out of thin air is because they create money before the underlying economic activity happens. They use that money to stimulate demand, which then leads to real production, goods, services, jobs, profits, innovation. The money triggers the activity, not the other way around. This is why governments can recover from recessions faster than individuals can. A person cannot create money. A business cannot create money. But a government, through its monetary system, can. The system is powerful, but not without risk. History is filled with examples of governments overusing this tool. Hyperinflation in Zimbabwe, the great inflation of the 1970s, currency crises in Latin America. These events remind us that money creation is not free. It must be balanced by trust, productivity, and stability. Yet, the modern world could not function without this ability. In 2008, during the global financial crisis, governments and central banks created and injected trillions into the economy to prevent a total collapse. Without that intervention, banks would have failed, savings would have evaporated, and the world economy would have entered a depression worse than the 1930s. Again in 2020, during the pandemic, the wealth machine activated at full force. Countries expanded their money supply rapidly to keep businesses alive, protect jobs, and stabilize markets. It wasn't perfect, and it had side effects, but it prevented economic freefall. This is the paradox of the government wealth machine. It's risky, but essential, powerful, but delicate, misunderstood, yet central to modern life. Governments don't create wealth the way individuals do. They don't create products, and they don't sell services. Instead, they create the conditions where wealth can exist, and the money that circulates within those conditions. Taxes convert future economic activity into today's resources. Loans convert future productivity into present spending. Bonds convert future stability into today's investment. Every part of the system pulls tomorrow closer to today. And the reason this works is simple. Economies grow. Over time, technology improves, populations expand, productivity increases, and society becomes wealthier. As long as the real economy grows, money creation remains sustainable. But this doesn't mean governments can create infinite wealth. Every country faces constraints: interest rates, debt levels, investor trust, currency stability, political decisions, central bank independence. These factors determine how far the machine can operate before it strains. When trust is high, governments can create money and issue bonds easily. When trust weakens, borrowing becomes expensive and inflation rises. This is why credibility is one of a nation's most valuable assets. In the end, the hidden wealth machine is not a mystery. It's the natural evolution of money, from metal to paper to digital entries controlled by institutions. Its power lies not in magic, but in design, in coordination, in the belief that society will continue to grow and produce,